Here we are. Welcome to Be the Boss of Your Money. I'm Mitch Goldberg. It's time for the live stream that teaches you all about personal finance, investing, where I, as a financial advisor for over 30 years, shares with you the lessons that I've learned along the way of an industrious career. I've seen all kinds of people overcome all kinds of financial challenges. And I take all of that and I don't just use it for the benefit of my own clients. I like to share it here. A few reasons. Look, people who are my clients watch the show, but more importantly, maybe you'll consider becoming a client one day. More importantly, though, I appreciate you spending some time with me. Your time is valuable. It means a lot to me. This is Be the Boss of Your Money. We're talking about the Delta variant, the COVID versus earning season, and we have pretty much the best earning season since maybe late 2009. When I say earning season, this earning season is a knockout, powerful earning season, not just because we're still comparing growth to last year, which was the peak of the economic shutdown. So you'd expect year over year great numbers, but even taking that out, the numbers are incredible. So what's going on here? We have to talk about Facebook, Ford, and a few other companies that reported numbers after the bell. Got a bunch of things to talk about. You're watching Be the Boss of Your Money. Let's roll the quick intro. We're going to get into a whole bunch of things. It's going to be a good show. I'm going to teach you some new things that you might not have known about, and I'm super excited. Really. If you have any questions, I love hearing from you. Please ask away in the comments. If you're watching in the replay, thank you to you as well for joining me. I will see your questions and I will get back to you. So here's the intro, and then we're going to come back and look at the COVID map. Here we go. Well, I don't know what that was. It looks like it got stuck for a second. Sorry about that. Should I try it again? Let's try it one more time. All right, got stuck. I don't know why. I mean, maybe I'll have to re-download it, but that shouldn't happen. Oh, the beauty of and splendor of live streaming. I happen to like live streaming because there's more of a homemade feel. It's real content. It's, me in the YouTuber vlog space doing my thing here. Now I see more people who are just joining us right now. So thank you so much. If you're just joining us now, we're talking about COVID, the Delta variant versus the earnings season that's taking place right now. The Federal Reserve wrapped up its 2-day meeting, and Fed Chairman Jerome Powell came out and said, we're pushing pedal to the metal. We are not stopping with our aggressive, easy money monetary policies. This is the international hand sign language for pressing the pedal to the metal. Okay. So if you have any questions, hit me up. Let me know where you're watching from. I love it when I see you out there. I love it when you give me a like or something. I see Wendy is out there. Hey, Wendy, so nice to see you. Thank you very much for joining me. Tendy Wendy in Florida. That's awesome. You're the best. Okay, so if you have any questions, hit me up. We're going to talk about a couple of things, and I'm going to go through the quick usual market wrap, sprinkle in my little words of wisdom details. It makes you look. My hope is that you become a better investor and better at personal finance from this live stream show. But if all you get out of this is just the conviction that you need to stick with your investments through thick and thin, so you don't panic and sell in a down market, then I'm happy. That's like, if you get that much out of this, I'll be thrilled. But hopefully you get a lot more out of it and I talk in my own colloquial way. Yo, sup, Josh. Josh is out there in the house. Thank you, Josh. Thank you so much. Always great to see you, man. You were just like, if I had a Patreon account, like you'd be my number one numero uno. Okay. So let's do the quick share screen. We're going to take a look at what happened today. All right. I'll pop myself up in the corner here. First, let's get to the U.S. markets. I'll make this a little bigger so that you could see it on your screen, on your little smartphone there. Dow off 127. Not really that big of a deal. I'll tell you why the Dow didn't go up in spite of Boeing, which finally had a good day. Like Boeing finally came out with their earnings and said, we did better than we thought. Cash flow is better. Earnings were way better. We're selling more planes. The airline industry is coming back. And it was just one of the most bullish things you could see. Boeing is a huge supplier. So Boeing is so big that it actually impacts the imports and exports of the United States every month. Okay, so what else do we see? NASDAQ had a big day. That's basically thanks to Google being up almost a little over 80 points on the day today, just Google alone. S&P was off a little bit because Google couldn't do all the work for the S&P 500. Gold up a little. Oil, it's been 70 to 75 for a long time now. It doesn't really move the needle at this point. All I could tell you is that oil stocks, which were expected to do so well in the beginning of this year, they had a good start, but lately they've just been dead money, lagging. They've been fossils. Yeah, oil stocks have been trading like fossils. Okay, let's keep going. The 10-year Treasury, 1.23%. I think a lot of people are hoping the 10-year Treasury, that's this number right over here, this 1.233. I think a lot of people are hoping that that would be a lot higher by now because that would reflect a stronger, improving economy. Not yet. The VIX continues to come down. Even though the markets didn't have a great day today, the VIX still comes down. Usually the VIX would go up when the market has a weak day or a flattish day, but the VIX still went down. So people are expecting over the very near term, the VIX is a very near-term indicator, like 30 days tops, 30 days out. People are expecting a pretty calm market, okay? Let's take a look at a couple of other things. I want to look at the Treasury. Okay, so we already looked at the 10-year 1.234%. Look at that. The Treasury is at, look at that. The 10-year yield is 1.234. That's 1.234. I don't think it just changed to 1.236. I thought it was so cool that it was 1.234. Oh, well, let's take a look at crypto. So Bitcoin back over 40,000. It's just 29,000 like a week and a half, 2 weeks ago. I was just talking to my friend Filippo right here about that stuff. And if you missed the episode, this is what the thumbnail looked like. This was us, Filippo, handsome guy in the blue blazer there. Let's ask a crypto expert. But we were talking about crypto. So I've put out some new content. If you're on Instagram, you could see all the short snippets that I pull from these live streams, the little valuable pieces of information. I post them on Facebook, on LinkedIn, on Instagram. Instagram, my handle is at InstaMitchG. So go follow me over there and you won't miss a beat. But if you want to watch the lives, obviously you have to be connected with me on LinkedIn, Facebook, either my business page or my personal page, or YouTube. My YouTube channel is Client First Strategy. Go check it out. Subscribe, please. Really would appreciate that. All right, so Bitcoin back over 40,000. Ether was up. Litecoin is up. XRP. These are the big ones. And then we have Doge, which I don't even know why I honor that with a mention, but it's almost kind of like fun. I don't know. It's Doge. All right, so it's like 0.205 versus yesterday's trade at 0.202 and yesterday's close. That's 0.202. All right, so that's crypto. And let's take a look at the watch list. So here it is, folks, the winner of the day. Let's hear it. Let's give it up. Let's give it up for Google. Yeah. Okay. So Google up 83 points. That is a huge move, not just because Google is such a big company to go up 3% in one day in valuation. Google's been up all year. It's been one of the biggest winners of the year so far, and they still continue to go up, almost doubling their revenue from YouTube. Advertising level is just killing it. Advertising revenue, rather. Microsoft was off a little. Nvidia was. I don't use Netflix as part of my FANG stocks. This is my FANG M stocks. It's Facebook, Amazon, Apple, Nvidia, Google, Microsoft. So FANG M. The M is for Microsoft. There's no S, but you could leave out the S for savings. Wasn't that like mattress or something? And that was pretty bad. So Apple off a little, Amazon up. Amazon's earnings are coming out tomorrow, so that'll be a big one. But once that is out, that's it for these tech giants. Okay, let's take a look in aftermarket. The one I really want to show you is Facebook. Okay, Facebook is off by about $15 after hitting a new year high today of $377. Listen, this stock was like $265. I'm going to say about 3-4 months ago. So it's up over, it's like a $26 stock going to $37 in a pretty short amount of time. That's a home run. So the fact that it gave some up because they guided down a little bit, their guidance wasn't as optimistic as people thought. I say BS. I just think that expectations are so out of whack. I focus on these stocks because every one of you, anyone who's in individual stocks has these stocks. And if you're not in individual stocks and you're in exchange traded funds or mutual funds, or you're in a S&P 500 index fund, you're exposed to these stocks every day and to a big extent, like 20% of your portfolio. By the way, the S&P 500 is an index. You cannot invest directly into an index, but you could invest in a security that tracks or mimics an index. How do you like that? I just have like that. I just have that, that disclaimer right at the tip of my tongue. It just comes right out. Okay. Facebook off a little. Ford Motor had a phenomenal numbers and raising guidance. And Qualcomm hit it big because they're selling so many chips into the automotive sector. And as everything in the automotive sector is going EV, that should benefit Qualcomm. So should the move to 5G. So I have to consider adding Qualcomm to my repertoire of stocks. I had been in Qualcomm and I had gotten out for gains at about these prices. It must have been like 10 months ago. And then it came down. I was glad I got out of it. I have to revisit Qualcomm. That might be one to get back into. I'm not going to make up my mind right here and now. So we checked out Facebook. We checked out the watch list. Let's check out a couple of other things. Wait, while I have you, U.S. markets, let's take a quick. I told you I would tell you about the Dow. Okay, so why did the Dow go down? McDonald's was off $4. Travelers off. American Express, Visa was off 4. Procter and Gamble. But don't get me wrong; these stocks have all been up a lot. So in spite of Boeing being up 9. And Caterpillar up $1.54. The down stocks overpowered the up stocks in the Dow, and it looked like today, the old economy stuff is the stuff that just didn't work. Like if you weren't a tech stock today, like a big tech stock today, with the exception of Apple, Microsoft, they were just off a smidge. It just wasn't your day. But overall, I wouldn't look into these moves today for anything. And let's take a look at the biggest movers after market trading. Facebook, we just saw, they saw revenue growth of 56% since 2016. Could you imagine growing that as big as they are? They keep growing. PayPal tumbles 7% after hours. They beat analyst estimates by 3 cents, but they missed following a miss on its second quarter earnings and lower than expected guidance. It's all about the guidance. It's like, okay, the quarter is over. When companies are reporting today, they're reporting on the second quarter that ended June 30th, which is just about a month ago. So people want to know, how are you doing this quarter? We saw Qualcomm had a pretty good number. All right, so let's get to the Fed decision. This is the biggest thing of the day. If you want to know what the biggest news is, Fed holds rates near zero, says the economy has gotten better even with pandemic worries. The Delta variant is spreading like crazy. And even where I live on Long Island, New York, in the county that I live and work in, Suffolk, we are considered, there's 4 levels, 4 being the worst. We're a 3. So where I live, um, it's actually recommended now by the CDC that we go back to wearing masks indoors. That's a tough one because everywhere I go right now, nobody is wearing a mask and people are basically not paying attention to anything. It's just, people are burnt out. It's people are out, but that we'll see how it goes. But it takes a scare to get people. It would take a big scare to get people to go back to wearing masks. People hated it. This article here was written by my good buddy, Jeff Cox of CNBC. Thank you, Jeff, for being such a great writer. But some of the things I want to highlight is the committee said in a unanimous statement that the economy continues to strengthen. You know what? You're not looking exactly what I'm looking at. It looks like it's, here we go. Wonder why it's not going down to popping up the way I expect it. All right, well, this is Jerome Powell. Okay. This is what Powell says. I'll read it to you because it's not showing it to you. But what we've seen is with successive waves of COVID over the past year and some months now, there has tended to be less in the way of economic implications from each wave. We'll see if that is the case from the Delta variety. But the bottom line is the Fed is not thinking that the Delta variant is another shutdown for the economy. We'll march through this. We're in much better shape than we were before. If you get the vaccine, you're mostly protected. Even if you do get COVID, a lot of people say, oh, you could still get COVID. Yeah, but it's not about getting COVID or not. It's not about being exposed and getting the coronavirus. There's a difference between having the coronavirus and that turning into COVID and a really bad case of it, which could put you in the hospital and even kill you. It's about not flooding the healthcare system. Hospitals is what this is all about. All right. That's what it's about. So anyway, we're going to keep going to the main story here, and we're there. We are right there. Okay. So this is the main story of the day. I want you to take a look at this. I'm going to pop myself in here. All right. Stick with me, guys. This is good stuff. I really work hard to make these shows for you guys. Come on. Show me some love. Give me a heart. Give me a heart. Give me one of these. And I always appreciate it, okay? So it's a little tilted on the side of the screen. I could make this a little bigger. Okay, there we go. So this is the COVID map. I am on the website of the CDC. And you could go check this out for yourself. But if you're a longtime watcher of the show, during the pandemic, I showed every day, the most important data point a year ago was the Johns Hopkins COVID tracking map. And I showed that every day. It was part of the show. Now what I'm switching to is what I want to show you is the COVID map. Let me just put myself in a different part of the screen. Okay, I think that's a little better. All right. Who's that? Michael, love your show. Michael, thank you very much. And we still have to get together. I think you and I were just about ready to make plans to get together right before the pandemic started. I have to get so many plans back on track with so many people. But Michael, you are at the top of the list. You, and I can't wait to see my buddy Josh Barron in person very soon. So this is the map. And it shows you Long Island. I don't know if you could see it, but Long Island is orange. And if it's orange, that means it's a substantial. You see that? High, substantial, moderate, and low. I would say maybe the amount of counties in the United States that are in a low zone of community transmission of COVID is maybe 7 or 8% of the country, but probably half the country or more is substantial or high. Certainly where I live, again, Long Island, Nassau, and Suffolk counties are in the substantial. We've got a lot of cases here, and it's rising pretty rapidly. And even though my community where I work and live in, the COVID vaccination rate is about 75%, which is very high. There's other parts of Long Island where it's still a lot lower. Okay, so I just want to show you this. And maybe I made this map a little too big, but if it allows you to click on different counties if you actually go to the website, and you could actually find your county and see how red it is. But in, like, Missouri and Florida, those are 100% red. But if you take a look at, the South has a lot of red, Midwest, a lot of red. There is some blue in the mid-Northwest, I guess. So we'll see. But it's this versus earnings. So that's what is. Jay, I see you out there, buddy. Thank you very much, Jay. Jay Spindell. Thank you very much. So that is the map. So it's this map versus earnings. And that's basically what we're watching. So I'm going to wrap this up for you and say that if we're not sure when the COVID peaks, but I know that England is starting to relax. They stepped up their vigilance. They're stepping it down now. Now people can travel back and forth if they're vaccinated between the United Kingdom and the United States without having to quarantine. That's brand new news. And then last thing is to talk about inflation, because we were talking about the Fed. So the reason I brought up the Fed is because the Fed does not see COVID as a major impediment to the economy. If it was an impediment to the economy, it doesn't necessarily mean that the stock market has to go down, because as we saw, the economy cratered in 2020 and the stock market kept hitting new highs on the backs of companies on the backs of the stocks of companies that enabled you to work from home and stay at home, shop at home, etc. And that's why the stock market went up last year, in spite of a horrible economy. And then if we get another shutdown, I don't think that's where we're going, but the same stocks, we'll just go into those same stocks. I keep saying here, don't just own the work from home, stay at home tech stocks. Don't just own the reopening, inflation, reflation trade. You have to own both. Rebalance, I think, is the best way to go, and stay diversified, which is a strategy that we use to reduce risk, but it doesn't necessarily protect your portfolio from a generally down market. Filippo has a comment. I always appreciate your comment. Filippo has a lot of good comments. Apple, let's go down more. Love the dip. 7-layer dip. When you buy the dip, you're talking the stock market, right? You're not talking about like the sour cream and onion soup mix dip. That's like the dip that I like. Okay. All right, so let's talk about one more thing about Powell, and then I'm going to let you go. I promise. We're talking about inflation. The Fed met today. A lot of people are like ripping hair out of their head. As you can see, I don't rip hair out of my head. I don't rip hair off because I don't really have enough to go around just to make a point. Okay. But a lot of people are ripping hair out of there and say the Fed should tighten. The Fed should start to get out of this easy money policy. At the earliest, we expect interest rate increases. The Fed today left interest rates unchanged as expected between 0 and 0.25%, citing that their dual mandate of inflation and labor hasn't yet been met. They want to see more strength in the labor force, more people back to work, and they want the labor market to be more equitable, not just an overall good labor, not just an overall labor market that's strong, but they want to see minority employment improve as well. So this is a very different thing for a Federal Reserve that just goes by the cold, hard numbers. We now have a Federal Reserve with a heart, and that thinks with a heart and emotions, as opposed to just going by data. Is that good or bad? You tell me. I think it depends from your viewpoint. The risk is inflation. There are a couple of risks. I just want to make sure I follow my notes. The Fed still says they see inflation, most of it today, as transitory. But when housing prices go up and wages go up, those tend to be sticky kinds of inflation. So I don't think you really get such a pullback in inflation when supply chains normalize again. Ultimately, what happens when wages go too high and companies can't cut wages, they figure out how to replace employees with technology, right? Technology is the biggest destroyer of jobs, by the way, not foreign competition. I don't know if you know that. Just wanted to let you know a little economic history, okay? So having said that, the Fed remains sanguine about inflation. Sanguini. I would like a little sanguini with white clam sauce and a Chianti. Okay, I'm really hitting the sound kit today. Okay, they don't think COVID's a major impact on the economy. The economy continues to strengthen even with a flare-up in the Delta variant. They don't see housing or stocks as a bubble. It did annoy the crap out of me that Jerome Powell said he does not think that the Federal Reserve bond buying program, they buy $40 billion of mortgage bonds and $80 billion of treasury securities every month to keep interest rates low and keep money flowing through the economy. He says he doesn't think that has much of an impact on the housing market. I don't agree with that at all. I vehemently disagree. I beg to differ. In fact, I think it takes a lot of nerve to say something like that. It takes a lot of nerve. It takes a lot of chutzpah to say something like that. That's right. I have to work that in here. So I have to work that word in there, chutzpah. Okay. Hope you're not feeling too verklempt after I say that. So anyway, these are the things that we're watching. That's what I'm telling you. The Fed is going to keep the pedal, like we started in the beginning, the pedal to the metal. They don't see, nobody really sees an interest rate hike, according to the CME Fed Watch, until late 2022 at the earliest. But that means the Fed has to start tapering their bond buying before that. So we expect sometime over the next 14, 16 months, the Fed will have started tapering its bond purchases. We don't know if that frightens the market or whatever, the stock market, but I think they have to try. I don't think the Fed needs to take its cues just from the stock market. I think the Fed has to start to let the economy run on its own and put all of this stimulus to the test and see if it really worked or if we have something else that we have to fix. All right, that's it. I'll be back tomorrow. Thank you so much. And if you have any questions or topics you want me to cover, let me know in the comments. Bye.